Welcome to meeting number 35 of the House of Commons Standing Committee on Finance. Today's meeting is taking place in a hybrid format pursuant to the standing orders. Before we continue, I would ask all in-person participants to consult the guidelines written on the cards on the table. These measures are in place to help prevent audio and feedback incidents and to protect the health and safety of all participants, including the interpreters. You will also notice a QR code on the card which links to a short awareness video. I would like to remind participants of the following points. For those of you who are participating by video conference, please click on the microphone icon to activate your mic, and please mute yourself when you are not speaking. For those on Zoom, at the bottom of your screen, you can select the appropriate channel for interpretation, either floor, English, or French. And for those in the room, you can use the earpiece and select the desired channel. A reminder that all comments should be addressed through the chair. And pursuant to Standing Order 1082 and the motion adopted by the committee on Monday, March 9th, 2026, the committee will resume its study of household debt in Canada. And I would like to welcome our witnesses. Comme individu, on donne la bienvenue.
As individuals, we would like to welcome Mr. Philippe Dastu, full professor, HEC Montreal.
President for Canada, and for MNP LLP, we have Mr. Grant Bazian, President, and Ms. Sherry Aberbach, Senior Vice President. All virtual witnesses have conducted a mandatory sound check, and now we will begin with opening remarks. And Monsieur Dastu, on va commencer avec vous pour 5 minutes.
Mr. Dastu, we'll begin with you for 5 minutes, please. Thank you for the invitation. My name is Philippe Dastu. I'm an associate professor and director of the Financial Education Laboratory at HEC Montreal. As part of my research, I have studied household debt from several angles, including minimum credit card payments, hire purchase agreements, and mortgage payments. One finding from my research is that the problem is not only household debt, but also that many credit products remain difficult to understand, even for educated consumers. Debt can become problematic if households make credit decisions today without fully understanding the future financial implications. I teach a personal finance course as part of the Bachelor of Business Administration program at HEC Montreal. Even among business students, many of the basic mechanisms of debt are poorly understood. For example, does the bank charge interest on a credit card if you only pay the minimum amount? Are the equal installment payment plans offered online really free of charge? As an exercise, we study debt contracts in class to better understand their terms and conditions, and it is clear that they often remain difficult to read. To fully understand where we stand with regard to household debt levels, we must also ensure that consumers fully understand the impact of their financial choices. Otherwise, they may find themselves more vulnerable to adverse shocks in the future. Taking the example of minimum credit card payments, my research shows that two types of consumers are likely to pay the minimum and therefore incur high interest charges: those who are unable to pay more, and those who are able to but may not understand the high interest costs they incur by paying only the minimum. When examining installment purchases, my research shows that some households tend to take out these loans sequentially, which means that they have to manage multiple monthly payments simultaneously, and that puts them at greater risk of default. Because it incurs costs, the use of high-interest credit represents a trade-off between consumption today, borne by high interest costs, and the ability to pay in the future. Households need to fully understand that when they take on debt, their present choices may restrict their future financial flexibility. 2 points seem to stand out from these findings as key to improving the situation. First, it is important to present the true cost of credit in simple, clear terms. And secondly, it remains important to step up financial literacy initiatives at an early stage, so that young consumers, who will be the borrowers of the future, are better equipped to understand the consequences of their borrowing decisions. Research shows that education has better results when it's done at the right time, when borrowing decisions are made. Thank you for your invitation, and I will be glad to take questions in both official languages. Thank you.
Merci, Monsieur Dastu.
Thank you, Mr. Dastu, and we'll continue.
For 5 minutes, please.
Thank you, Madam Chair, and thank you, everyone, and thank you for your work. My name is Brian Dykema. I'm the president of Cardis in Canada. Cardis is a think tank that studies the relationships between individuals, markets, the state, and civil society. And our goal is to see civil society, markets, and the state working together to form a flourishing society. I'm going to be speaking to you today on the effects of the introduction of online gambling, and particularly sports gambling, on household debt. I'm going to be sharing some data with you that comes from some of our studies, along with a recommendation or two that can help address this challenge. Online gambling, and particularly sports betting, was introduced in Canada in 2019. It was done through the provinces via an exemption from the federal government to allow the provinces to do that. And today, about 1 in 3 young adults gamble online. In Ontario alone, there are about 1.3 million accounts of online gamblers. And again, to be clear, we're talking about not people betting on a poker game on a Saturday night or anything like that, but people who are betting online. And the average player account of the 1.3 accounts sustains net losses of $283 per month. The Canadian Centre for Substance Abuse and Addiction say that players should not spend more than 1% of their pre-tax household income. And for that number, $283 per month of losses to be true, someone's income would have to be $340,000. And as somebody who lives in Ontario, I can assure you that is not the average wage. For the average Ontario household to spend less than 1%, they should be losing no more than $89 per month. In other words, it is more than 3 times more than the safe allowable limit. Those who are spending over that allowable limit, those who are exceeding the 1% threshold, are 4.3 times as likely to experience financial harm, the harm that Professor Dastus was referring to, the trade-offs between interest and so on. They're 4.7 times more likely to experience relational harm, things like divorce, domestic abuse, and things like that. 3.9 times as likely to experience emotional or psychological harm, depression, anxiety, and things like that. And 4.4 times as likely to experience harm for health problems, so things like substance abuse and so on. That is a huge challenge in Canada. And the Canadian Centre for Substance Abuse and Addiction also reports that those who are spending on or who are gambling online, of those people, almost a quarter of them reported experience a high level of gambling related harms, including reduction of savings, increased credit card debt, the very debt that the professor was speaking about, and challenges with managing their household income. Compared with a regime in which there's no private gambling or no private online gambling, we have compared that and seen the number of calls that have come into mental health addictions. And we have seen, particularly with young men aged 15 to 24 years, there has been an increase in calls to the addiction lines by 144% to over the last few years to 337%. It is a serious problem. And we have seen that this is actually mirroring evidence that has done, empirical evidence that has been done in the United States. And I'll share a little bit about that data with you. In the United States, they have studied the difference between states that have online and sports betting. They can see that credit scores actually decline by about 0.3% in states where there's legalized forms of sports betting. Places where there's legalized access to online sports betting, the effect is nearly 3 times as large. Bankruptcy rates are up 25 to 30% 3 to 4 years after online betting is legalized. We're beginning to see that in Ontario as well and in other places that have legalized it. Debt collections increased by 8%, and debt consolidation loans, the loans that people are using to try to manage their debt, increased by 10%. It is a massive problem. Why is this happening? It's the Stanley Cup playoffs right now. We all hope that the Montreal Canadiens bring the cup back to Canada, or at least I do. And one of the things that's a reality is that more and more people watching games, watching sports online, are being subjected to absolute harassment of betting, people encouraging them to bet, often young people seeing sports for their first time and beginning to understand it purely through betting. One study shows that there's 2.8 references to sports betting every minute of a sports broadcast, and on average, about 1/5 of the total broadcast time includes some sort of gambling reference. When you watch the Habs win on Friday, just watch the boards, watch the advertising. You'll be subjected to it. It is a fairly significant account, and it is something I think that can be done. It is a new a negative effect on Canadian households and on their debt, and it targets a particularly challenging population, that of young men who are having challenges for savings, finding work, and so on. And so our encouragement to this committee is to recognize that this is a massive contributor and will be a growing contributor to the problem of debt in Canada, and that we should be doing something about it. I would draw your attention to Senator Marty Deacon's bill, which is—
Mr. Dykema, if you could wrap up quickly, please. Thank you.
Okay. I would encourage you to follow that bill and to support it if you can. That's all I have to say. Thanks so much, everyone.
Okay. No, thank you. We appreciate your enthusiasm. And I note around the table there were many excited faces when you talked about the Montreal Canadiens. And apologies for mispronouncing your name at the beginning. So I would like to now turn to our witnesses from NMP for 5 minutes for opening statement. Thank you.
Thank you, Madam Chair and members of the committee. My name is Grant Bazian, and I'm the president of MNP Ltd., one of Canada's largest consumer insolvency practices. I'm based in Vancouver. No hope of the Canucks bringing the cup back anytime soon. Besides me is Sherry Aberbach, a senior vice president of MNP Ltd., and Sherry is based in Montreal. Our trustees meet thousands of Canadians every year, and the trends we see are consistent from coast to coast. As you are aware, household debt in Canada is the highest in the G7, but it is not just a macroeconomic statistic. What we see every day is the reality behind that data. Mortgage renewals rising by hundreds or thousands of dollars a month, cost of living outpacing income, reliance on credit for basic expenses, younger families entering the housing market with record debt, seniors on fixed incomes who are unable to keep up. These pressures are national and persistent. Housing is the largest driver of household debt. Many Canadians have no margin for error, and even a small shock, a job loss, an illness, a rate increase can trigger a crisis. Inflation has slowed, but the cumulative rise in prices has permanently stretched budgets, especially when wages have not kept pace. At the same time, more Canadians are turning to high-interest credit, which can quickly become a long-term burden. By the time they reach a trustee, many have already maxed out credit cards, taken high-interest loans, used payday-style loans, and or refinanced their homes, sometimes multiple times. These patterns reflect limited alternatives and delayed intervention. Financial distress is also a mental health issue. Many people we meet are experiencing anxiety, depression, and overwhelming stress, often waiting too long to seek help. Moreover, MNP has been conducting a consumer debt index survey with Ipsos for the last 7 years, and several clear recurring trends and concerns have emerged. Declining confidence after repeated economic shocks, rising resilience on credit for essentials, a shrinking financial cushion, many within $200 of insolvency each month, growing emotional strain, seasonal improvements that no longer lift sentiment, delayed financial decisions without improved resilience, and widening vulnerability among younger, lower income, and increasingly middle income Canadians. Canadians are adapting to chronic strain rather than recovering from it. The most important insight I can offer is that high household debt reflects financial literacy gaps, lending practices that normalize long-term indebtedness, and structural pressures, such as housing costs, inflation, and interest rates outpacing incomes. I now turn it over to my colleague.
Merci. Nous formulons 4 recommandations.
We would like to formulate 4 recommendations. First of all, increase public awareness of federally regulated debt relief options. Clearer public information would prevent reliance on unlicensed high-fee consultants. 2, strengthen consumer protections around high-interest credit. High-cost products trap households in long-term debt. Stronger disclosure limits on predatory pricing and incentives for lower-cost alternatives would reduce harm. 3, address the housing debt connection. Improve housing affordability through increased supply and reduced barriers to construction will reduce the need for excessive borrowing. 4, support practical financial education. Education should focus on real decisions such as mortgage renewals, repayment strategies, emergency savings, early warning signs, and understanding interest. Practical tools build resilience. In closing, household debt is not just a macroeconomic statistic. It is a daily reality for millions of people. The insolvency system is a vital safety valve, but it should be a last resort. With earlier intervention, stronger protections, and policies addressing root causes, many Canadians could avoid insolvency altogether. Thank you, and we look forward to your questions. Thank you very much to all our witnesses.
Minutes, please.
Thank you. To our MNP panel, we have heard at this committee repeatedly that the only thing keeping us from truly spectacular insolvencies and foreclosure and this type of thing is the resilience of Canadians by way of their ongoing refinancing of debt, skipping on other necessities, and draining savings, so that insolvency is a lagging indicator because people will burn all their savings and they will skip other expenses and they will see if they can stretch their debts out longer and longer for longer and longer periods. But is this a sustainable way for our economy to sustain these debt loads, especially when mortgage renewals are overwhelmingly resulting in higher payments for consumers because of the timing of when most people got deep into debt?
Yeah, Madam Chair, I think it's a very good question. I think what we're seeing more is people relying upon high interest loans, payday type loans. Prior to COVID, when people came in, they maybe have one or two on their statement of affairs. Now they're having multiple. So to your point, they're exactly using more debt to survive. Is it sustainable? I think as long as minimum payments are being made and no pressure is being put forward on these people, they're going to continue to live in that environment. But there will be a tipping point one day when some sort of shock or crisis hits them, whether it's a loss of job, illness, separation, or divorce. That will definitely have an adverse effect on their cash flow, and then that could be a very strong crisis that would tip them over into an insolvency situation where they may need our services to do a bankruptcy or proposal.
So if income loss is the main tipping point or the event most likely to trigger an insolvency, what do you make of the employment figures? We saw 108,000 job losses in February. I don't believe the March numbers are out yet, but what do you make of the unemployment, the rising unemployment, and the effect that this has on the indebtedness, on indebted Canadians?
Well, I would imagine that jobs are created as well, so I don't know how that's going to turn around, right? So if those people that are losing jobs aren't finding jobs in the near term, they'll have to rely upon other terms of credit or savings for sure. How long and sustainable that would be, it's hard to say, but I would imagine that they would probably find jobs in due course, maybe not to the same level. Is it sustainable? It's hard to say.
Okay, well, net loss of 108, so it's 108 not finding a new job, but with respect to your recommendations, recommendation number 3, since housing is the main driver of debt, and and the pressure of housing is what drives people into, I presume, is a factor in driving people to high interest rate debt and payday loans and credit cards and this kind of thing. The housing supply. You had quite a bit to say about that. If you've got some more you want to add to that recommendation, I think the committee would be happy to hear it.
Well, there seems to be a shortage of housing for sure, and people want to keep their house if they have one. So what they're doing is they're spending all their time and money trying to keep their house, and as a result, all of the other payments are suffering. When people come to see us, there's two things they like to keep: their house and their car. And with a housing shortage, they may be stuck with alternatives like high rent. And that hurts their cash flow for sure.
Our witnesses on Monday, or a witness on Monday, said that the condominium or the housing starts have gone over the cliff in terms of absence of housing starts in Ontario. 0 starts last month in the GTA for condominium construction and single family, and all of the levels of housing starts are down. How do you anticipate this to affect insolvencies in the indebtedness of Canadians?
Well, I don't know if it's 100% linked that they can't start a house. They have to live somewhere, so they're probably renting. But if there's a shortage of housing, rent may go up, and that may be a tipping point for some if they can't afford the rent to come see us to help solve their financial problems.
Just quickly, with a minute or so I've got left, Professor Dastiou, you spoke about plain language contracts, being able to be clearer with Canadians about what they're borrowing and the increase of financial literacy. But given all of the factors we've heard already today about affordability and the pressure of the cost of living and the wages not keeping pace with the cost of living and interest payments on things like mortgages increasing, is there anything really other than an increasingly productive economy that allows for higher wages, better incomes to support people long term? I support financial literacy, I support plain language contracts, but none of those things are going to solve the cost of living crisis.
Of course, but you need to understand when you get into that contract at the first place that it's going to limit your future self in the margins of adjustments that you have. So I think that's the emphasis I'd like to put here. Yeah.
Great, thank you, Mr. Kelly. We'll continue now for Mr. McDonald for 6 minutes.
Thank you, Madam Chair, and thank you to the witnesses. We've kind of seen an evolving theme as we've been doing this study for several weeks now and hearing from a lot of different witnesses. And the picture is obviously there's Canadians struggling with household debt. I think the high inflation that has ended about a year and a half ago is starting to offer some relief. Heard the comments that there was wages aren't keeping up with inflation. Well, actually, the truth is that wages are exceeding inflation in the last 12 months since Prime Minister Carney came into office is what we're seeing. But what I really wanted to focus on, and I was interested in Professor Dastiou's talk about behavior and how it affects people's decisions in debt. Professor, we're seeing a lot of financial institutions offer installment-style payments. So even credit cards now with BMO or whoever, they're offering you to make the payments over several months. Digital banking platforms offering special deals. This is something that we weren't subjected to previously. Is this creating more problems for people as they break these payments down into smaller amounts? Do they make bad choices as consumers? Can you comment on that?
So that's a great question. And I've studied administrative bank level data on consumers who use these installment loans. The installment loans we had in our data was the old type of loans. You buy a couch, you pay it on installment, you buy a TV, you pay it by installment. But one of the findings we had was that across all type of consumers, they're more likely to get a new loan as soon as the first one expires, whether they have the liquidity or not. And what that tells us is that some people rely on these types of loans, even if they perhaps have the liquidity not to rely on these loans, but for some reason they agree to pay high interest to get on these loans. And this high interest that you pay on these loans is not very productive. Okay, it's money you could use to do other things, maybe increase your education, maybe find a better job, but you're using it to consume.
Okay, and then on another topic, you talked about financial literacy. A couple of the witnesses have mentioned financial literacy has been something that is flagged. We see students entering university today, and it's a different world than if you're as old as me, you have grown children. So when I went to school, it was cash. There was no credit cards. There wasn't that risk of making bad choices. Today, and I've lived this with my children, they're managing tuition, they're managing rent, they're managing credit cards, and they're managing that first time away from home. And they tend to not have the financial literacy to deal with all those items at once. So to both maybe Ms. Aberbach and Professor Dastus, could you comment on what we can do better to get young students or young adults ready to understand financial terms?
Sure. Thank you. Okay. Thank you, Professor. Absolutely. And I think the earlier that you start on the education, the better it is. Even in primary school, starting to explain to them what the math is, that you can only spend what you have. Back in the day when you talked about having cash, when you had a $20 bill in your pocket, once it was gone, it was gone. And today that's not the same thing. It's very easy when you tap on a credit card or you tap on a debit card and it's gone. It's fun. It's a different type of experience. So the earlier we can start teaching the kids, and then as it goes into high school and later on, you're hoping that they'll have a much better understanding as to what the financial products are out there and what it truly does mean to be solvent and to have more and to put away and to put aside and start, even if it's $1 a week, to start putting away and start saving for the future.
And I can only agree with this. One thing I want to add is students come in my classroom. For example, they don't understand that you still pay interest on your credit card if you make only the minimum payment. But once you teach them that you do pay interest, they understand it and they're going to use it. So financial education does work. Financial literacy is important. It's the basic building blocks to make sure that in the future, you won't find yourself in over-indebtedness.
And then another question, as government officials, high household debt is obviously something many Canadians are struggling with. What would you recommend that we do differently in policy, other than the affordability measures that we've put in? Like since our government was formed a year ago, we've brought in the grocery and essentials benefit, which is going to help out families up to $1,900 this year, and then $1,400 for 4 years afterwards. We've brought in a reduction in income tax rates for all middle-income Canadians. Is there other measures we should be looking at? And anyone can opine in on this.
Very briefly, in about 20 seconds.
Oh,
Ultimately, I think the long-term effect to fix that would be education, as we've all alluded to. Short-term effects, I think there definitely is an understanding that long-term debt is fine to have in this country. I was never brought up that way. I don't think you were either. So I think that's it's difficult to fix it immediately. I think there's a long-term look we have to have here in terms of education and maybe changing society's outlook on debt, that you can have it for a long-term period of time.
Great. Thank you very much. Thank you, Mr. McDonald. Monsieur Garon, pour 6 minutes, s'il vous plaît.
Merci, Madame la Présidente. Merci.
Thank you, Chair, and thank you to all the witnesses for being here this morning. I'd like to start with you, Professor Dastou. In the discussions we've had since the beginning of this study, sometimes we get the impression that we're talking about indebtedness as if it was something that people were forced to do, they had no choice, that people forced loans on them. I think it's a question of individual freedom. People get indebted because they want to get indebted. And it ties in with financial literacy, to be able to do it right, to make a budget, to understand contracts, and it requires financial literacy. We have some witnesses before the committee who told us that in Canada, we're almost a model of financial literacy in the world. And when we look at the research in the field, it's not so much the literacy that's important as the time when the literacy is provided, because people often get indebted in situations where there's a shock, they lose a job, it's very emotional, it's very short term. There are times when sometimes the rational side of the human being is not at the forefront. So what does it give you to have had financial literacy courses 15 years ago when you have to borrow money when you're made vulnerable? And what can we do to help people that are placed in a vulnerable situation when they face a loan? Thank you for the question. When I look at financial literacy in Canada compared to other countries of the OECD, I see that we're pretty much all in the same situation. I'm not saying that Canada really stands out particularly, neither higher nor lower, but it's pretty similar. We all have gaps. And in addition to that, as regards just-in-time education, what I see in my classes is that when students come in and I talk to them about retirement plans, I talk to them about those types of topics, they're not interested. When we talk about mortgages, credit cards, and budgets, and loans, and bursaries, then they're interested. That's what we find in our research. So you have to make sure that you talk to young people the right way, at the right time, on the topics that are important to them and the subjects that will affect their future. So when there's a problem of indebtedness or sports gambling, well, then we have to go and talk to those young people so that we can, at the time when we can prevent a problem. So I understand it's an ongoing process that differs depending on the time of life. We have a professor at INRS who came to talk to us about the difference between indebtedness and over-indebtedness. And what we realize from his research is that certain people are over-indebted and are very vulnerable for bankruptcy or because of shocks in their life, a loss of a job, maternity, professional injury, or occupational injury, and so on. The Canadian Employment Insurance covers only about half of the people who ought to be insured. We know how important the social safety net is and a lot of programs that are there, provincial programs. And what about the public policy on the safety net to prevent the worst cases for some households that may be over-indebted, and then there are situations that come up? In certain of our studies, we study job loss. We take data from Statistics Canada and administrative data. And what we realize in recent years is that increasingly people are turning to what we call entrepreneurship after they lose a job. We note that job losses cause a loss of salary that can last for a number of years. And the fact that in our work we see that people turn to entrepreneurship, it shows that there may be something like there may be 108,000 net job losses. Some of those people are going to try turn toward self-employment, gig work, or entrepreneurship. Thank you. Your opening comments surprised me a little because I had the impression that people were never so interested in financial issues, investment, real estate. A number of times in this committee I've raised this. The social networks contributed a lot to that, and now you've come to us and you've said essentially that your students, I'm not saying it's typical of the HEC, don't take it as an attack, but your students are unable to draw up a budget pretty much or understand the financial impacts of their decisions. I would like to know whether young people are perhaps ill-informed. Do they get their information from the wrong sources? And what is the role of the AMF and the provinces and in Quebec, or what's the role of the federal government to try to counteract the wrong information that's floating on social networks that has become a major source for young people? Well, I think that the important thing to note, as you said so well, is that young people are more interested than ever in personal finance. They come into my course. It's a course I give that they have the most interest, but we have to refocus them, maybe because they listen to podcasters and influencers and they get a lot of information, and a lot of information is floating around on social media. But in the university situation, we can refocus them and get them on the right track and understand their choices. What about those who don't go to university? That's where we really have to, I think, look at upstream financial education. Fortunately, in Quebec, we have that. In fifth year of secondary, we have a course in Quebec. I've seen groups of students that have followed it and that have not followed it, and I see a difference in the way they think, in the way they deal with those problems. So obviously, it has to start before the students enter my course. Thank you. Thank you. Thank you, Mr. Garon.
Thank you, Madam Chair, and welcome guests. I'm going to talk, I read MNP's brief on this, and the one statistic that we hear a lot is the number of Canadians. I think it's 40% of Canadians are within $200 of insolvency every month. Can you please explain what that means? Does that mean that every 40% of Canadians come home at the end of the month and go, if I didn't have this $200 that I had in my balance sheet right now, I would be facing bankruptcy? Is that what we're talking about, or can you please explain it, because we've heard it for a long time?
Yeah, that comes from our survey, and it's a.
Can you please explain what it means?
Sure, yes, of course. It's a sentiment survey, and this is what people feel. So whether or not they're going home and actually doing the math, they're feeling that at the end of every month, they're $200 away from being insolvent, meaning that they cannot pay their debts in an ordinary fashion, or that they're assets are less than their liabilities. It's just a state of financial being. It's defined in our legislation. So what they are feeling is that if they had less than $200 every month, they may be insolvent and they may be at a point where they have to come see a trustee.
Okay, thank you. I'm going to switch now to talking about debt service ratios, because in Canada, our debt service ratios for consumers is around 14%. About 14% of disposable income in Canada goes towards debt service. The commensurate number in the United States is about 11%. So 11% versus 14%. Can you explain why it's higher in Canada than it is in the United States?
I really can't without any form of certainty. I would imagine that the cost of living may be a part of that. Could be relative to interest rates and inflation. I haven't really studied that to answer that with any sort of certainty.
Okay, so our cost of servicing debt in Canada is 3% higher. About half of that is mortgage debt, and half of that is consumer debt of some sort, whether it's autos or credit cards. And yet the Bank of Canada rate is 2.25% versus about 150 basis points higher in the United States. So the United States banks charge more interest, and yet the United States consumer pays less interest. Have you thought about how that doesn't work, how that equation isn't fitting for Canadians versus Americans?
I haven't done the comparison, so I know I haven't thought about it.
Okay. Maybe I can prompt you a little bit here. Our debt situation in Canada has mounted extremely high in the last handful of years. We're up to, at the federal level, $1.3 trillion in debt. When you include the provincial debt, we're at $2.5 trillion and an extra $2.6 trillion of consumer debt on top of that. With the mounting debt in Canada, primarily from governments, do you see potentially a crowding out of debt available for consumer means, and as a result, higher interest rates?
I'm not really sure to answer the question. I'm not really sure I understand it.
Okay, well, let me explain a little more clearly. No matter how much the Bank of Canada lowers the interest rate, the 5-year rate doesn't seem to respond, so the mortgage rate is still elevated compared to the bank rate. So that indicates there's a crowding out in debt markets, and the big actor in debt markets continues to be the government. Can you see that maybe if the government wasn't taking as much debt space, that there would be lower rates available to Canadians?
Seems like a good question for an economist rather than a trustee, but that is a potential.
Okay. Given how much Canadians are in debt here, they're making choices. The number one choice Canadians make when they spend money is food for your family. And yet more than 2 million Canadians per month are lining up at food banks. Do you have any idea in your research how much more outstanding consumer debt there would be if this availability of food banks wasn't there for Canadians at the very basic level at this point in time?
We haven't done any empirical studies on that whatsoever. All I can say is that people that come to see us suffering financial concerns rely on credit to pay for some of their food essentials.
Now, those people that come to you for credit, are they already using food banks?
I haven't done that corollary, that equations to determine if they're doing the same thing.
Okay, so they're either going to food banks or using potentially, if they're seeking credit protection, they're actually going to food banks, or they're putting their purchases of food on credit cards at this point in time. Would you say that? And that's 22, 24% interest?
That's something that we are seeing, is that they're using credit for essentials like utilities, food.
So
Thank you very much, Mr. McLean. That concludes your time. We're going to continue now with Mr. Sawatsky for 5 minutes.
Thank you, Chair. Mr. Dykema, thank you so much for your introductory remarks. I find very similar concerns when it comes to gambling and how widespread this has become. I'd just like to note that the Maryland Center of Excellence on Problem Gambling reports that individuals with gambling disorder have a suicide rate 5 to 10 times greater than the general population. That's 4 to 40% or higher attempt suicide. And when you think about how common sports betting has become, this is a serious issue, and it's become very normalized when it comes to watching sports. Gambling becomes part of what people are doing. And this is, you mentioned the Marty Deacon's bill. This has been supported by my colleagues, MP Bardisi as well as Bardish Shagar. I'm very happy to hear that there's some movement here, so I share your concerns. One of the things I wanted to ask about is how does real-time betting play into this when people are watching sports and making these impulsive decisions while the sports are ongoing?
Yeah, thank you very much for that question, and your insights are accurate. The increase of suicidation and otherwise is very much there. The real-time betting, what it does, Madam Chair, is it creates an environment where betting on a sports game resembles more and more like a slot machine. And studies have shown that the closer something comes to a slot machine, the speed, the ability to go up and down very quickly to make quick decisions, it triggers dopamine hits in one's mind that makes it more addictive. And so in line, you can get higher wins, higher losses at the time, which sort of, for people who have done any betting, that's what actually drives the excitement and what drives the addiction. And there are a number of studies, including studies that we've cited in our papers, that show that in-game betting actually creates a situation which resembles an electronic gaming machine, and those are the most addictive. Studies have shown that those are the most addictive. So what effectively you're doing, Madam Chair, is you are turning a hockey game, which you should be enjoying and should be watching and going with the ups and downs with your family or your community or in your local pub, and you're turning it into a slot machine. And if anybody's been in a casino, you can see that actually the affect on the face is not one of excitement that we see in the advertisements. It's actually one of a very flat affect, and that is actually what drives the addictions, and the addictions are what drive the questions of suicide that the member has noted. And so that is one of the challenges, that as we've turned more and more sports events into slot machines, we see higher levels of addiction, and particularly amongst young, again, I noted young men who have their own mental health challenges. And our goal is to try to actually create a bit of a wall around that. One of the things that we could do is Senator Deacon's bill, which would ban sports advertising. We would be in favor of that, and we would suggest that the members around the table, regardless of the party, it's one of these beautiful issues that the left and the right can agree on. The left wants to protect the vulnerable, at least this is the stereotype, and the right wants to ensure good fiscal decisions. Betting, the house wins, but it's never the household. It's always BetMGM, or in this case, the state, which I think is also addicted to the revenue. And so I think that's a very good question. Thank you so much.
Thank you, Mr. Dijkma. I actually had a friend who is going through an issue with this, who actually noted exactly what you said of the facade of a sports betting thing, but then once you're in the app, there becomes like slot machines and sort of casino-like gambling methods. And so that's very interesting. Could you speak a bit to the widespread advertising that we're seeing? Every sports game you're watching, you're starting to see tons of ads being pumped in for sports betting. Could you speak to that, please?
Absolutely. I will just note that your friend's observation about driving them towards the casino is exactly true, and that's exactly what the companies want, because again, those are the most addictive games, and that's where they want their revenue. So the sports betting is actually a hook to get them into that. As far as the advertising is concerned, I shared with you some of the data on the amount of time that people are spending watching advertising on that. It's about a fifth of a total production. You can see now that even the analysis is brought to you by companies. There has been, I think, a Faustian bargain between producers of hockey games, Rogers and other places, Sportsnet, and they have exchanged the cash of the advertising for effectively
Thank you, Mr. Dijkma. I'm going to
it.
have to conclude this round here. Thank you, Mr. Sawatsky. Monsieur Garon, on va continuer pour 2 minutes et demie.
Merci beaucoup.
Mr. Garon, 2 minutes and a half. Thank you. Professor Dastou, it's clear to me that marketing strategies by banks and financial institutions and the sales pitches of mortgage sellers and so on can have an impact on indebtedness and the type of contracts that people take on. When we look at your resume, we see that you know about personal finance. It's very public. So I would like to know whether If you go and see, for example, a mortgage broker, if you think that they're going to try to sell you a product differently than someone who's not well informed, and what would be the difference in the sales decision and the impact on what contract is selected? It's a very good question. Without talking about my own personal experience, we also have research on the effect of the financial advice. And I would say that overall in our expendable research with real financial advisors, we see that the recommendations that they make and decisions are good. We don't see major errors, but like everyone, financial advisors can also have gaps. So sometimes they may have a tendency to recommend products that they have themselves. They have biases, that is, the products that they know or trust in. So as to whether those products are good for the consumer or not, that's another step a bit beyond what my work can show, but that is an impression that results in the literature show that there is a bit of a familiarity bias. Excellent. We have 1 minute left, so I'll make it a short question. According to you, do banks prefer minimum payments that are higher or lower on credit cards? Do they prefer people to remain indebted with a risk of default, or do they prefer that people pay off their amounts? In the study we did, it's quite clear that a bank chose to increase the minimum payment on its credit cards, and we had consumers that were affected and others that were not affected. And the increase in the minimum payment leads to an increase in defaults. So as a general rule, the banks won't like that because they'll have losses. But it's a difficult compromise to find for banks because minimum payments that are lower make it possible to earn more interest income, but higher minimum payments makes it possible also to make sure that the debt will end up being paid off. So the question is not all that simple to answer. Thank you very much. Thank you. Thank you.
For 5 minutes, please.
Thank you, Madam Chair. Mr. Bazian, a question for you. You just finished mentioning that, unfortunately, a lot of Canadians are relying on credit card debt to cover the basic essentials, some of which, of course, are groceries. And Statistics Canada released also that transportation, housing, and food is costing Canadians approximately 104% of their income, and that that Canadians are about $200 away from not being able to meet their financial obligations. What have you seen is the cause of this? What is the root cause of this trend?
I think it's a combination of many things. We talked about gambling today. Gambling is part of it. Drug addiction, illnesses, job loss, breakups of families. Those are all combining to cause this. I wouldn't attribute it to one particular issue that's outstanding. You have to look at it in a case-by-case situation. But keep in mind that when people say they're feeling $200 away from being insolvent, it means that they're not going to be able to make their payments in an orderly fashion. So they may rely upon debt after that $200 amount, right?
Have you seen a concentration within any given group of Canadians?
I would say you're probably seeing it a little bit more in the younger generation because they have more really debt to deal with. They typically have mortgages, car loans, youngsters that they have to care for with daycare. They have, as opposed to the older demographic, which typically has those debts paid off. So I would say it's a little bit more common in the younger generation and those that have a lower income.
And what impact does this increase in indebtedness, especially amongst young Canadians, have on things like family formation, for instance?
Family formation? I take it like just having families? Well, obviously you'd probably have to ask them directly. We don't ask them if it's going to, when people come to see us, we don't ask if their debt is stopping them from having a family. But I think that younger Canadians are having fewer children. So that may be part of it. They may be fearful of starting a family if they can't afford just living on their own with their current debt obligations.
In this recent Consumer Debt Index report, it said that a third of Canadians, so roughly 32%, could not absorb an interest rate hike. And of course, given the statistics that we're talking about, I mean, that's intuitive. So with many Canadians increasingly reliant on debt to to cover basic expenses like food. Could you describe what even a slight increase in interest rate would do to those that are struggling most?
Yeah, it pushes them closer to a tipping point, right? Every time there's an interest rate increase or some sort of inflationary measure that causes consumer goods to increase, it pushes people closer to coming to see us and maybe doing a formal insolvency filing like a bankruptcy or proposal. The tipping point would vary per individual, but it does inch them closer towards having to come see a trustee.
And of course, I mean, we're doing this study because we want to understand what is driving this trend of increasing indebtedness and why Canadians are having to rely on credit card debt for basic needs. But also to get your recommendations in terms of how do we break this trend? Because we are seeing this trend that's being consistent even post-COVID. And you know, some of the solutions are, you know, one-time handout here and there. But what would be your recommendations in terms of a more longer-term sustainable solution that Canadians that find themselves in that situation would need?
That goes back to some of our original comments about the financial gap has to be closed. Not all Canadians, but many people that come to see us do not understand how interest works. They don't understand the financial burden that they're putting themselves in just by making a minimum payment, how long that debt becomes normalized. So I think that's a fundamental part of it. That's the root cause is education. But a lot of people know how to do a budget, and a lot of people understand how interest works, but they still come to see us because they simply can't afford to live the way they're affording. Sometimes they make bad decisions. They try and keep up with the Joneses. They're overspending for that purpose. But a lot of people are just having a hard time making ends meet. Their income is insufficient just to pay their rent, pay their interest obligations. It's a combination of all of those. So, but fundamentally, to answer your question, I would say education is a big component of it, and somehow changing the psyche, the culture, that long-term indebtedness is normal. And I think that's a big problem that we're seeing.
Thank you very much, Ms. Kobina. That concludes your time. We'll finish this hour with Mr. Turnbull for 5 minutes.
Thanks, Chair. Thanks to all the witnesses for being here today. Just wanted to state on the record that statistics show that wages have outpaced inflation for over 3 years. The latest results actually show that wages are growing at over twice the rate of inflation. So just to ground us in facts and statistics, I know the Conservatives particularly don't like hearing that stat, but it is the truth. A K-shaped economy we've heard about with the idea that the people that are in the lowest, most vulnerable positions are the ones that are being most impacted. We did an analysis in my office recently about all the supports that we've wrapped around for all the different cost of living pressures that are on families. Roughly an average family of four, we totaled the income tax cut, the CCB, the child care, dental care, groceries and essentials benefit, the National School Food Program. All of these things add up to about $30,000 per year. That's significant support. Can you just speak to how much those things have helped alleviate a problem that would be much worse today if those weren't in place?
We haven't done a study to come up with that answer. All I can say is that people coming into our offices simply just can't make ends meet, despite any subsidies that are out there. All of those are helpful. I think there are interim solutions. Whether or not they are long-term solutions is questionable. But that's what we're facing is people coming in, they're spending more than they are earning, and they're having a hard time making ends meet with the income that they have.
Okay, thanks very much. I'm going to hand it to my colleague, Kiran Bardiji, for some questions now.
Thank you, Mr. Turnbull. Thank you, Madam Chair. A few questions for Mr. Dykema. Thank you for sharing some of the facts and figures around the impacts of online sports betting in Canada. And I just want to throw a few more on the table. Ontario Internet Gaming cash wagers increased 31% year over year from September 2024 to 25. It's now an $8.6 billion in receipts. 89% of sports gambling related accounts are opened by boys and men aged 15 to 44. And people who self-report problems with online gambling self-report at a rate 45 times greater than those who are primarily lottery users. So we have some big issues here. And I just wanted to get a bit into some of the issues. I'll ask you just a series of questions, short questions here. Who's making money in this sector? Who are the beneficiaries? We've heard about the costs. Who's benefiting?
Yeah, I think the primary beneficiary is actually the state, and that's something that we've argued for a long time. Many people are concerned about the fact that there is, they're worried about the people, and I think that that's exactly right. What we have argued at Cardis and what the data show is that gambling revenues effectively function as a tax, and particularly as a tax on the vulnerable. We've done studies on who's betting, and those with the lowest income bet the highest proportion of their income on it. It's regressive in nature. So you have the state as the primary beneficiary, and then you have large companies like BetMGM and others who have created that and who are getting the most.
What are the responsibilities of teams, leagues, and broadcasters in this industry?
Unfortunately, the leagues are also addicted. They had a number of people moving away from their sports, so they turned to sports betting to drive revenues. In 1990, the NFL commissioner says nothing has done more to despoil the game that we play and watch than widespread gambling on them. Players themselves, many don't like it. They say I'm not an animal to be bet on. Unfortunately, they're hooked to the revenue, and it's a huge challenge for them.
Is this kind of economic activity worth the cost?
It is not. There's nothing wrong with betting. I'd be happy to play poker with you and give you my money because I'd probably lose. But the reality is what we have is an architectural structure, a choice structure that is actually taking money out of people's pockets and putting it into the pocket of the state without the accountability that we normally have.
You've shared some of the addictive features of online gaming and how a positive, pleasurable sports experience can become tainted. Your think tank is, you described a bit about what it does, and it's also animated by Christian values. I just want to understand a bit, what does better look like? We've got Bill S-211 to help it regulate the online sports betting and advertising sector. What else does better look like?
One would be actually to stop the advertising. We know that advertising works. That's why people spend money on it. And so stopping that would actually prevent people from putting more and more of their money to it. It's also important to change the architecture. They're actually preying on your imagination rather than the work of buying a house, doing all the work, starting a business. It's just imagine the freedom. And that's a huge challenge. So getting rid of that is one. The other is to look at how we actually take that money. We suggest moving out of the consolidated revenue funds. One of the things we've done is actually create prize-linked savings accounts, which allow people to bet, but those monies stay in savings accounts that it can actually be used as a savings regime. We know that people who have less than $250 in their accounts are more than 5 times likely to use things like payday loans. And so we're suggesting that the state should get it out of its consolidated revenue funds, stop it being a tax, and increase it being a savings vehicle for people like they've done in France and in England.
Great. Thank you very much, Mr. Dykma. That concludes the time we have allocated for today's meeting. On behalf of the committee, I would really like to thank the witnesses for your time and your efforts today. And if it is the will of the committee, we shall adjourn. Okay, great. Have a great weekend, everyone. Thank you.